Hi, John. Thank you so much for joining us today. So let's just dive right into the questions. Why are segments like company code, cost center code, project code, and GL code important in a chart of accounts?
It really comes down to if you want to be able to see P&L or the financials from that point of view. And if you're thinking about your general ledger, then you have you can look at things as how does the company look? How does this entity look? What's this cost center's profitability, as an example? And then you mentioned project code and GL codes and others. I would argue that company code, certainly you need to be able to see what is the full P&L view, or at least what is the financials for that company. Also for the cost center, what's the cost and expenses specifically to that department or such as marketing or IT to help drive performance. Project code, it depends. I would argue it should be a large project, like a major initiative that you're doing, or a major development effort where you do need to have that project full P&L, because it's a lot of work to maintain and to integrate that into your system. And then just the GL is what ties all those together across assets and liabilities and enables that full view across the different, call them business units that you're talking about.
Okay, that's understandable. Moving on to the second question. What are some best practices for naming conventions for these segments, and why is standardization important?
I'll call them standard ways. Like, as you said, default ways of being consistent is the main thing, and making it so that when somebody's looking at these codes, they understand and kind of interpret what you're talking about. So with company code, as an example, understanding as part of that, you think about what is the syntax within the code. So it might be that there's a country at the beginning, like US.001 could be a company code for a US entity. Cost center could be, you might put some letters that represent an example, like MKT001 could be marketing. It really is, though, you want it to be able to be something so that a human can interpret what these codes are. Doing them in a sequential order of revenue and different departments can also be helpful. And then when you're doing a project code, as an example, something that is, again, I would suggest a major initiative you're doing, but you want to be clear that these are the costs that relate to it for a given year. You might say, this is project code XYZ or whatever, but then put 24 at the end, like the year, or something that represents what year it's for, so that as you're looking at your costs for a given period, it's very clear how to distinguish. Even if it's a major initiative program, you want to know that these are the costs for 1 year versus the next year. In that example, I've used that before. But just consistency is the key thing. And it should be easy enough to interpret how those codes are going to map to, if you think about your management reporting, aspects of summary of management reporting and what periods they go to and things like that.
Okay, yeah, I agree with you. So moving on, what are some common mistakes accountants make with these segments, and how can they be avoided?
One example is people are putting the wrong transaction to the wrong code, so misclassification of codes. And then if you do that, the thing that accountants hate is having to do reclassifications. Because if you get an auditor coming in and say, oh, that was done wrong, and then you have to later reclassify something, whether that was because it was a mistake or because the business changed and maybe the timing of how things were coded wasn't accurate in time. But having to do reclassifications is always painful. And then oftentimes, if you're in a big public company, you've reported numbers, you just don't want to do that. It can create big problems with investors. Redundant codes. So seeing that there's actually, you can have, I like to call it blowing out your chart of accounts, where you just have too many codes. And reality is, the accountant who's trying to map things to the code, there's no difference between A, B, or C from their point of view, or maybe the transaction would apply to all of them. So they'll usually just pick one, and then you end up having two other codes in that example that just aren't used. So that's, if you've blown out your P&L, your chart of accounts too much, then it's kind of a waste of time. Also, inconsistent coding. So if you have, say, I was describing some of the syntax before, if you use like 3 letters and then a number, or if you use 3 numbers, a dash, then a number, you just want to be consistent so it's clean. And that's hard over time. Things change. But doing the classic example in this is, I've been involved in companies where previously they had put all of their products into the chart of accounts, into the GL. And that might be good intent at the beginning when you only have a few products, but then they have like dozens and dozens of products. Every time the product wants to reshuffle how they're presenting their products, you would need to update your chart of accounts to map to that. And so I've seen problems from that before because you don't remove the historical accounts, you just add new ones, and it's problematic.
I couldn't agree more with you, John. Moving forward, how can organizations maintain the integrity of these segments in their ERP systems?
Yeah, it really comes down to data governance. So you need to have consistency and integrity of the chart of account segments. I think one of the best ways of doing that is having an owner, having role-based access controls, controlling who has authority to update that. Oftentimes that comes down to the job of the controller. And that's kind of one of the main jobs of the controller by definition is control which accounts are going to be called what things and try to maintain some consistency, even though the business is changing, and enable so you can do historical reporting in the new views. But just defining the standardized naming conventions, doing regular audits and making sure that things are consistently showing up. I mentioned in a previous discussion about budget to actuals reconciliations. So if you're doing a budget or a forecast and how those map to your chart of accounts, that will flag if your forecast way you're going to look at the business is consistent with your, I'll call it historical way of looking at the business in your chart of accounts. Doing those budget versus actual reconciliations is helpful. And then automating validation rules so that as you're entering entries into the system, they're coded correctly. And there's different reconciliations controls you can put in place in most ERPs.
That is really insightful. I totally agree with you. Moving forward with the next question, what role does technology play in managing these segments effectively?
Yeah, I'd describe the main role is helping flag or raise inconsistencies for you to be able to see them, and either preventative controls or detective controls, right? Like it's going to prevent you from coding it incorrectly up front, or if you're on the FP&A side and you're seeing inconsistency, that can flag things for you that you can then work with the accountant to clean up. So automated detection, it may help generate the codes automatically based on whatever the transaction was. It can suggest different codes for you for the GL or the cost center. Just there's a lot of times of manual errors that can happen, and it can help prevent those as you're coding things. Data integrity, again, with the ERP system, looking for duplicates, looking for missing values or something that was hard coded wrong. And then dashboards, again, just it's always funny to me because the situation is when you have like a senior executive that really wants to see the real-time accounting, real-time dashboards of what's happening. But with accounting, you're always in the process of trying to catch up and, book the transactions. One of the companies I'm working with right now, the accountant got pulled into something else and he's 3 months behind in booking the accounting. It's a smaller company, but the executive wants to see his dashboards and the numbers are just wildly off. And so if management's making decisions based on these historical numbers that are wildly off, that's problematic. So technology can help keep you consistent and help book things in real time as they're happening so that you're just kind of managing by exception as opposed to having to book everything manually.
Understood. So we have almost reached the end of our interview. Can you provide examples of how errors in segment coding can impact financial reporting?
Well, I'll call out not only impact the financial reporting, but impact your whole business. Like if you're in a public company and you're coding something to the wrong place, then you report out those numbers. Investors make bad decisions, and usually then lawsuits can happen because they're like, oh, that was intentionally misstated, and we made investment decisions based on whatever. So I remember just kind of this tight schedule of closing the books and then rushing to get all the books closed, and then at the month end, and then accounting financial preparation done so you can produce investor analyst reports to a public company. And there was this army of like 30 or 40 investor analysts just waiting to dive in and find any anomalies in what you just reported. I remember just once or twice. Actually, I don't even remember if it actually happened, but I remember the fear was always like, if we miss something and then they're going to call you on it because it's wrong, you have to say, oh, that was an error. That's just bad for the team. So we avoided making errors. But you end up with misstated financial statements. You have compliance issues that auditors would find, and inaccurate profitability analysis. Like, what is the profit? What is the forecast? What's your guidance going to be for the next quarter that you're going to give? All those are off if your core things have been coded incorrectly.
So the last question for today, what steps would you recommend to an organization looking to improve its COA segment management?
Yeah, the first thing that I'd call out is verifying the historical accuracy and knowing what numbers you can rely on. I've been in the situation where a company hadn't had proper controls around their accounting historically when I was brought in, and previous to my joining, the owners had made different business decisions based on, well, they bought the company that I was then brought in to help them manage based on these inaccurate accounting numbers. And so then when I came in and figured out what actually was happening and why they didn't have enough cash at the end of each month, it was because of these basic accounting errors, which I'll say could have been avoided. So, just implementing standard close process, standard controls in place, naming conventions around what codes need to be what, and making sure that they're coded correctly and used consistently. Leveraging technology, I'd call out specifically AI nowadays. A lot of the ERP systems, when I started my career, different ERP systems were different. Oracle, SAP, QuickBooks, they all kind of competed on feature functionality. But nowadays, they're also similar in their core functionality. So there's other AI tools that can help leverage what's there and get your close faster, better, cheaper, less costly. Regular training, making sure that the team, and specifically I'll call it business rules, making sure that your different team that has the same business rules that they're following when they're coding things. Usually I'll have, like, if there's an accounts payable clerk, there's a one-page something that they use as guidance to know how to code what, where, as an example. And then putting in place the appropriate review mechanisms. As I mentioned before, if you're in a big public company and your numbers are going to investors, are making investor decisions in real time, you have a series of reviews and a series of controls in place, literally like number by number checking and automated checking, manual checking, and having a binder for each close to show what you checked and that you signed off on everything. Those are standard things when you're doing accounting closes for big public companies. But I'd argue what I spent a lot of my subsequent career doing is implementing those similar sort of controls for smaller companies that aren't big and public, because someday they might be. And regardless of whether you're public or you have investors looking at your numbers every day, you want to have clean numbers so that your management can make good decisions and grow the business. So consistency, completeness, accuracy, all your classic accounting things that auditors will look for later. Make sure those controls are in place. Don't rely on just your auditors telling you when you should fix things. Get them clean so that your management can make good decisions from the start.
Thank you so much, John. That was a really insightful conversation. Thank you so much for your insights. It was really nice to have you today with us here. And thanks a lot. Have a nice day.